Welcome back to The Explainer. Today, we're cracking the code on one of the absolute most frustrating dilemmas in the entire financial world. You see, finding a great stock, a sleeping giant company with incredible fundamentals, that's really only half the battle. If you buy in at the exact wrong moment, you are in for a very rough ride. And this brings us straight to the value investor's nightmare. Just imagine you find the perfect company. Its return on equity is crushing it above 15, the price-to-earnings ratio is an absolute bargain at 4, and it's got this massive dividend yield. You're thrilled, right? So you buy. But then the stock drops another 30% over the next 12 months. Was the company wrong? No. Was your fundamental analysis off? Not at all. The timing was wrong. Listen, having great fundamentals is absolutely useless if your entry timing forces you to wait years just to see a single dollar of profit. So here's our roadmap for today's explainer. We're going to cover microsignals, macro waves, the 4 market seasons, bringing it all together, and finally the ultimate investor challenge. Let's dive right into section 1, microsignals. It is honestly amazing how much of a story a simple shape can tell you. A candlestick chart is basically a visual representation of the daily battle between buyers and sellers. It gives us 4 key data points: the open, close, high, and low prices. The thick part, the body, shows the range between the open and the close. If that body is green, the price closed higher than it opened, meaning the buyers won that day. If it's red, the sellers won. Now those thin lines sticking out at the ends, called wicks or shadows, show the absolute high and low of the day. A long lower wick on a red day, for instance, shows that sellers tried to push the price way down, but buyers fiercely fought back. But here's the thing, you can't just look at price alone. You absolutely have to look at volume. Volume is just the number of shares traded in a given period, but it acts as the ultimate lie detector in the market. The golden rule here, never trust a price move that isn't backed by strong volume. If a stock breaks out upward on high volume, that is institutional money, the smart money, stepping in. But if it breaks out on low volume, be very skeptical. It's likely a trap pushed by small traders that's going to quickly reverse on you. Moving on to section 2, macro waves. Look, stock prices do not just move randomly. They move in waves, or trends. Step 1 is to identify that trend. An uptrend is simply a series of higher highs and higher lows. A downtrend? Lower highs and lower lows. And step 2 is vital. Trade strictly in the direction of the major trend. The trend is your friend. Fighting the overarching market trend is exactly like swimming against a raging river. It is exhausting, and it usually ends badly. Now to smooth out all that daily noise and truly see those major trends, we use moving averages. The 2 most famous signals here are the golden cross and the death cross. A golden cross happens when the 50-day moving average crosses above the 200-day moving average. This is a massive bullish signal showing that buyers are taking long-term control. Conversely, a death cross is when the 50-day crosses below the 200-day. This is your blaring warning alarm. For context, it appeared in late 2007, months before the absolute worst of the 2008 financial crisis hit. Next up in the toolkit is the stochastic oscillator. This is a momentum indicator that measures exactly where the current price sits within its recent range, mapped out on a 0 to 100 scale. When the line drops below 20, the stock is in the oversold zone. Selling pressure has hit an extreme, and a reversal might be imminent. When it spikes above 80, it's overbought, meaning buyers are getting exhausted and greed is peaking. But a quick pro tip, don't just act blindly on these zones. You want to wait for the lines to cross back out of the zone to confirm that momentum is genuinely shifting. All right, section 3, the 4 market seasons. This overarching cycle is governed by what we call the percent optimism strategy. This is a long-term indicator that calculates where the current price sits within a historical trend band based on the compound annual growth rate, essentially the market's historical average return. It measures market extremes on a pendulum swinging from 0 to 100. It answers literally the most critical question in all of investing. Are we currently in bull market euphoria, or are we in bear market panic? Here is how this builds into an actionable plan using the 4 seasons. Winter is when optimism drops below 25%. This is maximum fear, the bottom of the cycle, and your required action here is to buy. Spring is 25 to 50% optimism. The market is starting to recover, so you hold or cautiously buy. Summer is above 75% optimism. This is maximum greed, the absolute peak of the market. Your action here is to sell and lock in those profits. Finally, autumn is 50 to 75%, where the market starts cooling off, and your required action is simply to wait and hold. Tracking these seasons gives you a concrete blueprint for managing your portfolio. Section 4, bringing it all together. Let's bring everything together. You now have 6 incredibly powerful tools in your technical analysis toolkit. You've got candlestick charts to read price action, trend identification to know the direction, moving averages, plus the golden and death crosses for trend signals, the stochastic oscillator for oversold and overbought conditions, volume to confirm the genuineness of a move, and finally the percent optimism strategy to identify exactly which season the market is in. You need to use these together. The more signals that align, say fundamental analysis says buy, the stochastic says oversold, and optimism says winter, the higher your confidence. That is when you act.
Which brings us to Section 5, the Ultimate Investor Challenge.
Warren Buffett famously said, "Be fearful when others are greedy, be greedy when others are fearful." It perfectly summarizes our percent optimism strategy. When optimism hits summer, when literally everyone else is greedy, you must be fearful and sell. When optimism drops into winter, when the masses are panicking, you must be greedy and buy. But actually executing this in real life, when the news is terrifying and your portfolio is bleeding red, that requires immense psychological warfare against your own instincts.
In the next explainer, we tackle the hardest part of investing, your own mind, the psychology of the masses. We're going to break down exactly why investors consistently buy at the very top and sell at the very bottom, and how to use that against them. It is one of the most eye-opening topics in this entire series, and I'll see you there. So, what season do you think the market is in right now? Drop your answer, winter, spring, summer, or autumn in the comments below. I read every single one. Hit like if you learned something new today. Subscribe so you don't miss Explainer 3. And click the card right now to go straight to the next explainer, Why Most Investors Lose Money, Investor Psychology and Personal Analysis. Keep investing wisely.